Good morning, good evening, wherever you may be, across the nation or around the world. My name is Shane Squark, and on behalf of the CMT Association, I am pleased to welcome you back to another webcast as part of our educational web series. Today, on November 20th, 2019, we are pleased to welcome Dimitri Speck back to the web series as he presents how you can benefit from little-known seasonal and cyclical patterns. Dimitri is a fund manager, financial analyst, and trading system developer. He writes one of the biggest stock market letters in Germany and authored the book, The Gold Cartel. In 2013, he won the Hedge Fund Journal's Award for the Best European Commodity Fund. In 2018, the Scope Innovations Award for his seasonal investment strategy. Speck is a publisher of the website www.seasonx.com, where interested investors can conduct seasonal studies on more than 20,000 instruments. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box to the right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of our formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association continuing education credits, which will be automatically added to your account if you registered online through the CMT Association website. With that said, it is without any further ado, I am pleased to turn the floor over to Mr. Dimitri Speck.
Thank you very much, and welcome to the audience. It's an honor for me to speak again here at CMT. Last time it was still MTA. The topic is a seasonal and cyclical pattern. And most people know, of course, about seasonality in the field of commodities or stock indexes, but there are much more seasonal patterns in many markets. There are seasonal patterns in indexes, of course, but also in individual stocks. There are seasonal patterns also in currencies and commodities, of course, and even in bonds. So much more instruments have individual seasonal patterns than commonly known. And I will also go further in this presentation because there are not only seasonal patterns with a duration of 1 year, but there are also intra-month patterns, intra-week patterns, intra-day patterns. And in addition, there are recurring events like, for instance, FOMC meetings or when the future expire and all these things. And they also have an effect on the markets, and we will go to some of them. So I start with one of the most known seasonal pattern. This is the sell in May and go away. Yeah, it's known since the 1930s, and despite of that, it did exist all the time after that. And I show you in this chart how strong this pattern is, because in the blue line you see the performance of the Dow Jones since 1960 in the winter period from November to April. And the red line is the equity line of so the performance from May to October. So the opposite, if you would not follow the saying sell in May and go away, which is also known under the name Halloween effect. So you can clearly see that the Dow Jones did a huge performance in total if you had been invested in the winter period. Yeah, this is this blue line, and you had done almost no performance if you had been invested only in the summer period. So this shows already that there is something behind this sell in May and go away, or the Halloween effect in general. And one of the reasons are investment flows. Yeah, here into mutual funds, you can clearly see that in the season from May to October, there are much less inflows into mutual funds than in the other season. This was for the US market. I did a research of this Halloween effect also in other markets, namely in the 11 biggest markets of the world, according to the market capitalization. Yeah, the 11 biggest countries from Canada until the United States, starting from the 1970s. Yeah, here's the index which I used for my calculation, and as far when the data started, my time series started. And here you have the return in the 6 summer months of each particular country, and here in the winter month. And you can see only in 2 countries, Hong Kong and India, there was a reasonable return also during the summer months. In all other countries, the return during the summer month was either a little only or even negative. Yeah, Taiwan, for instance. Yeah. So this Halloween effect exists in 9 of 11 countries significantly, and also in Hong Kong and India, where you have some performance, the winter period is better than the summer period of the year. Yeah. And how does it look like? I show it here for UK from 1984. You see in red again the performance of the summer months, yeah, which is more or less 0, yeah, just nothing. Yeah, in blue you see the FTSE index, and in green you see the winter month. So in UK, the winter season has even a little bit outperformed the FTSE. Yeah. So also a clear indication that the sell may go away. This very simple seasonal approach does work internationally. And I show it also for Germany, yeah, from the 1970s, the German DAX. In red, you see the summer months, the equity line of the summer months. In blue, you see the German DAX. And in green, you see the winter season. Yeah. Clearly, the winter season is much better than the summer season, and even better than the DAX. Yeah. So again, a strong indication that sell in May and go away works. Yeah. Sell in May and go away is a very simple seasonal approach, of course. If you want to go more in detail what we are doing, you need better tools, and a very good tool is a so-called seasonal chart, which shows you a seasonal trend at a glance. Yeah. How is a seasonal chart constructed? In principle, you just plot the chart of an instrument, the line of an instrument, for instance, a stock or a stock index, for each year start with 0 or 100%, and then you compute the average. The result is then here on the right, a seasonal chart. I will go to this more in detail soon. In this case of a stock called Choice Hotel. And this chart depicts you shows you the average curves of the returns of the stock prices over a particular specific period, for instance, 10, 20 years. Yeah. And in this case, you have here a strong seasonal pattern caused by frequent earnings surprises, by the way. And here you have the year-end rally, or the autumn rally, and starting in October. Here you have, by the way, the months. Here you have the prices, the price measurement, and here you have the seasonal trend. Yeah. One hint I must give you: the calculation of seasonal charts is not that easy because of you have to combine several mathematical problems. You have to overcome some mathematical problems. And the result is that in the past, before I did for the first time make a precise, accurate seasonal chart, you had either what you see here on the left, a precise daily information, yeah, but no price information. It goes here from 0 to 100. and also the levels are not comparable. Yeah, this is from MRCI, by the way, this example. So this was the first algorithm which did show you a daily seasonal chart, but the price information got lost through this algorithm. And then there was another approach, which you can see here. This is a precise price information, but you have here only one information per month, so it's not daily. Yeah. So to overcome this, you need a lot of mathematics, which I did and which I offer you in SeasonX. But there are also other, in the meantime, other websites or blogs or books even, which shows you seasonal charts. Several of them are not precise and correct, just to warn you. Yeah. So how does a precise seasonal chart looks like? Here you have it for the Dow Jones. Yeah. And calculated over 30 years. Here again, the monthly scale. Here you see the price information, and here you have the daily and information of the price. So you can look at every moment where the move, how much the movement was. Yeah, and the Dow Jones, you can see, is strong in the first months, particularly starting in January. Here we have the sell in May and go away. Yeah, but in reality, the Dow Jones did rise a little bit longer if you go and have this precise information. Yeah, and it had weak months from August to October. Yeah, and here the autumn rally starts. And here you see in the very end the Christmas rally, yeah, which is one of the strongest seasonal pattern in the history of the stock indexes. Now I look, does seasonality changes, of course, always a topic, and for that I look also over a much longer period of 116 years. And you can see the seasonality of the Dow Jones. Yeah. Also here from May to October we have a sideways trend, but also here you can see that there is a second up movement up in the long run from July until end of August or beginning of September. Yeah. So here it shows you also how much sense it does make to have the precise information. And then you have again the autumn rally and here the year-end rally. If you are a trader or an investor, you want to look, of course, precise what is the performance and the figures between two dates when you buy and when you sell. This is very important information. And I show you here the autumn rally for the German DAX. This is a seasonality of the German DAX calculated over 20 years, which is somehow similar to the Dow Jones. Here you have the weak months, August and September. And here you have the autumn rally or year-end rally starting on October 8 until the year-end or some days more if you look here precise. And if you mark then in our app, you can immediately see the statistical returns, for instance, the average return from 9.21% or the annualized return, which is 45.36%. And you can see additional figures like median or standard deviation and so on. And you can see here also how the performance was in particular years. Yeah, we go later live, and you can also ask me then an instrument in which you are interested, and we can show you how the seasonality of these instruments is. Seasonality exists, and this is, in my opinion, very important in practice because you have much more instruments to invest and you have the possibility of a much better diversification. Seasonality exists also in particular stocks. Yeah, I show you here the seasonality of the Microsoft stock. This is an example which brought me to the seasonality of individual stocks, by the way, a few years ago. And again, here you have the months, here you have the price information, and you can see that Microsoft did until the end of September, beginning of October, did not rise at all in average, and then had a very strong move in beginning in October until November. Yeah? And when I found this a few years ago, this pattern, I was interested, what is the reason of that? Is it coincidence or is there some background? And I found they had just good earnings, much better than expected. And then I looked at the history of the Microsoft's earnings reports and the expectations, and it turned out that in this quarter, usually the earnings were much better than expected. So we have a kind of earning surprises which are regular in this quarter and higher and more frequent than in other quarters. And this earnings surprises causes this significant average rise, which is higher than the total rise of the stock itself, as you can see. So in 1 month about, you make the whole return, if you know this pattern based on a good fundamental reason, which is caused by earnings surprises. And this must also have some internal reason within the company. Let's say the business for Christmas, or let's say it's connected with fairs or with bookkeeping. There might be many reasons why companies have individual seasonal patterns, which are different than the seasonal pattern of the stock index itself. Another instrument which has a nice movement is the US dollar. Yeah, here I show you the seasonality of the US dollar index. Yeah, and the US dollar typically drops seasonal in the last month of the year and turns then in the first month of the year. And the reason for this is when something turns exactly at the year, the average, the reason is connected with bookkeeping, or more precise with taxes. It's US companies, big US companies benefit when they transfer money to daughter companies abroad to reduce taxes. I have this knowledge from a big, it was confirmed from somebody who worked in a big oil company in US, and they are really doing this, and this causes this pattern. It was, by the way, identified already in the 1970s by Larry William, who has published it most probably first, and it still existed in the decades thereafter. So we have seasonality also in currencies. And a very little seasonality, but from the amount of money. This is not connected now with the markets, the trading markets, but maybe also important for many of you, is the seasonality of home prices. Because home prices are not moving so strong seasonal, I show you here the deviation from the detrended average. Detrending means that at the end of the year we have the same level at the like in the beginning, and the normal price movement is mathematically removed. Yeah, and you can see here that the seasonal price of real estates is high in June, July, August, and September, and it's low in December, already starting November until March, maybe April. Yeah, and the reason for this is, yeah, I always ask when what can be the reason for this, and it's very simple. If you look in a flat or in a house in the summer months, is when there is a nice sun and until the evening it's hell, yeah, then the flat and the house is simply more appealing, more nice. And if you go in the very same flat or house in the winter months or in autumn when there is fog and it's dark and it's rainy, yeah, also it looks not so nice. So the people accept for the very same house a higher price when the sun shines compared when the weather is not nice. and when it's dark, and this leads to this seasonal pattern. So it means for you to, if you want to sell a house, start somewhere in April, May, and if you want to buy a house and it's November and you have found already a house, just wait 2 more months and the seller might go even more down with the price. Of course, this movement is not very, not a lot, but if you consider that the prices of houses are hundreds or even millions, then we are talking here about tens of thousands of dollars or other currency, same value, which you can save when you consider the seasonality. So we looked at the moment until now at the yearly seasonality. Now we turn to the intra-month effects. This is the average month of the S&P from 1928, and it shows you here is the turn of the month, here's the middle of the month, here's the end of the month. It shows you that the S&P typically does rise a few days before the turn of the month until a few days after that. This effect is, has the name turn of the month effect. It's published already quite a lot, and I show you how significant it is for the US market. Here we have the very same, the equity line of the turn of the month. This is from the 26th of each month until the 5th. So it's about 10 days. So in the blue line is the turn of the month, the equity line of the turn of the month, and the red line is the equity line of the rest of the month. And you can clearly see how much the short period at the turn of the month beats the rest of the month. And the reasons for this pattern is, of course, that there are payment flows. For instance, if you have a house and it's rented, you get it, or if you're just a worker somewhere, you get the money at the turn of the month. And this causes also investment flows into the stock market at this period. And I have calculated now the turn of the month, which is published very often for the United States, also again for the 11 big markets worldwide since the 1970s, or since the time I have time series starter. And here you see the performance of the mid of the month, the bad performance, and here you see the performance of the turn of the month. I have computed this with the same dates like for the US market, so I did not an individual optimization, which might even lead to higher figures. And you can see here how many countries like Korea have even a negative return of the mid of the month and a very high at the turn of the month. And in all countries, we have this effect of the turn of the month. And in all 10 countries, which are not US, we have the effect was bigger than in the United States. You can see this here, the difference in the United States was 2.3% since the 1970s, and in all other countries, especially of course in Korea, the outperformance of the turn of the month was much higher. Also on average, we can see that there is a high, it proves again that there is a very good reason and a very good statistical proof that the turn of the month effect exists, and it exists in other countries much more than in the United States. Where it's, so you can also make use out of it in other countries better. Another period is the week. I show you here from 2000 the performance of the S&P based on the close prices. That means the Tuesday performance, which is here in blue. This is the total performance in black of the S&P. Shows you the performance from Monday close to Tuesday close, and you can see here we have an average 2 good days, Tuesday and Thursday, and 1 bad day in the S&P. This is the intra-week effect. And I show you the intra-week effect for gold. And very interesting, gold has, here's again the average performance. Here from Monday to Thursday, almost nothing happens. And on Friday, an average gold makes a very good performance, which might be also caused to intra market effects, because Friday is a day when the S&P on average is weak, and quite often it happens when the S&P drops that gold is strong. Yeah. And now I come to the next period. This is intraday. Yeah. Here you can see the intraday chart. Yeah, this is an average over 20 years computed by millions of prices, minute prices, and of the gold market. Here you see the time, which is Eastern time. And here you see an afternoon fixing in London, which is in New York, of course, in the morning hours. And here you can see this chart I published first, by the way, in the year 2001. And since then, it's also proved in court that there was a fixing manipulation. And you can see that the price of gold typically drops to the afternoon fixing. Yeah. And you can use this, of course, not only to prove or to identify possible manipulations, but also to improve your trading. Yeah, I show you here from the last 50 days, the S&P intraday average. Yeah, this is again 9:30. That's Eastern time again until 4 o'clock p.m. Yeah, you can see here the best time to sell the S&P index was sometime after 11, maybe 11:20, something like this. Yeah, this is the intraday curve. So if you have this until now, due to the cost of data, is not in the CSNX app which is available in the internet. But if you are Bloomberg or Thomson Reuters ICANN customer, this is most likely if you're a professional and institutional investor, then you can make these charts with in Bloomberg or Thomson Reuters, just to inform you. And what I'm surprised always is how stable these intraday patterns can be, despite there is so much algorithm trading, so many computers. What you see here is from the year 2005, over more than 10 years. In black, the equity line of the S&P mini future. And in the other colors, you see the performance of time windows of a duration of 4 hours. And you see here that during between midnight and 4 o'clock in the morning, this is the red line, the performance was best. Yeah. So despite there is such a huge amount of algorithmic trading of computers, of high frequency trading and so on, even intraday pattern can exist over many, many years. This is really surprising in my opinion. And then I come to the events. After I did the normal calendarian periods, events are, for instance, elections, last holidays, last trading days, holidays, reports, FOMC meetings, and so on. And I show you here an example. This is the S&P around the FOMC meeting. Yeah, the FOMC meeting is 8 times a year. It lasts 2 days. Yeah, and on the second day, this is the closing price, this orange line of the second day is the FOMC announcement, whether the interest rates are increased or whatever. Yeah, and this is calculated by 160 events, so 160 FOMC meetings. This is the average cost of the S&P. And you can see that the day is 4 days before, 5 days before and 5 days after this, and you can see that from the close of the day before the FOMC meeting until the FOMC meeting ends, we have an average price increase of 0.4%, a little bit more. Yeah, this is huge. Yeah, and it's interesting because most people are looking at the outcome of the FOMC meeting, but there is an average almost nothing. Yeah, the days before are interesting, and this is very important for events to know that many events which are really affecting the market, which the public is interested, are not interesting when the outcome of the event is, but the days before. So it must have a psychological reason that this tension, that this looking of the events causes the investor to buy. So not the event itself is statistically of importance, but the days ahead. This you can see in many events. I show you this here also for the futures expiry. This time 15 days ahead and 15 days after this event, computed over almost 60 S&P triple witching days. You can see that about 9 days ahead and 1 day until 1 day before the S&P future expires, the S&P does typically rise. I think this is also quite an important information. And maybe many of you are interested in sport. This I did calculate how do sport events affect the stock market. Here I did take the stock indices of the countries where either Olympic Games are or soccer World Cups. So every 2 years we have this big sport event, which is of worldwide importance. And I took from the 1960s, for every country where I have data, I computed this average of movement, and you can see that in the country where the sport event take place, some 11 months before until 1 month before, the stock market typically rises, and then it's already when the sport event, this Olympic Games, for instance, in Japan, is the next one, when this starts, the stock market in this particular country typically drops again. So this has also a good reason, in my opinion, mainly the attraction through media, but also the investments which typically are being done from countries where we have these big sport events. Now I come to some practical tips. Yeah, it's always good for seasonality if there is a strong reason behind. Yeah, in commodities we have weather, but also for some companies we have window dressing, for instance. Yeah. We have taxes, we saw it for the US dollar. We have emotions, for instance, in front of events or during Christmas, which causes, in my opinion, the Christmas rally. Yeah, this positive emotion, this buying tendency of other goods goes over to the stock market. We have money flows. Yeah, I showed you an example. This is with the intra-month effect when we have the wages at the turn of the month. So there are many, many fundamental reasons for seasonal patterns. We don't know them all. Yeah. For instance, for individual companies, it's just too hard to figure out what the reason is why they typically report better earnings in a particular quarter. Yeah. So another thing which is important to consider when we are talking about seasonality is, of course, that not every year follows a seasonal pattern. What I show you here is the returns of each year in the time between December 14 and January 4 of the S&P in the last 69 years. And you see that this Christmas rally did occur quite often, and that these up bars are much more frequent and higher than the red ones. But last year, for instance, we had the worst Christmas rally ever in the statistics. So there are exceptions, like in every stock market or market approach. Yeah, whether you are using value or momentum or whatever, it does not work all the time. The same as with seasonality, of course. Seasonality can also change. I think this is also of some importance in practice. I show you here the seasonal trend of the Dow Jones from the mid-50s to the mid-80s when we didn't have the bull market, and then from the mid-80s to 2001 when we had a bull market. And it's quite typically for any instrument, if there's a bull market, then some bear patterns, like here this drop in May, disappear. So seasonality does change. Yeah, this is also clear in my opinion. This is just one example, but this does not mean that good patterns do repeat. In this case, the year-end rally, for instance, you can see in both charts. And how can you trade seasonality in practice? Yeah, one thing is, of course, you trade a seasonal pattern directly. Yeah, you buy the Microsoft stock at the beginning of October and sell it at the end. At the beginning of November, you trade this, the year-end rally and so on. Then you can use it for timing. Yeah, you can buy, for instance, if you make use of the turn of the month effect, just buy a stock if you want to invest in stocks some 5 days before the turn of the month and not after that, or buy stocks not in January, buy them, yeah, in average we have September, better time. Yeah, then you can use, so you can use all this seasonal pattern also when you are a long-term investor. This is also important to know. You can use seasonality as filter. Yeah, don't go short, for instance, when the stock market typically rises and so on. You can do it for every instrument. Yeah, and I will explain you more in detail. You can use seasonality for selection. Yeah, Microsoft in October I already mentioned. This I will explain more. And you can use seasonality as additional input for your existing trading approach. Here I give you an example for stock selection. Yeah, this is a Danish health company, Novo Nordisk, the seasonality, and you can see that this company typically rises in February. Yeah, and I show you another stock. This is Adidas. This does typically rise in March, April. So the idea is to select in February the Novo Nordisk stock, and in March, April the Adidas stock. Yeah, and ideally you just make this cascade of performance. Yeah, so this is how you can use seasonality for stock selection. Yeah, and this second, which I want to explain you more in detail, this is seasonality as additional input for your existing trading approach. Yeah, I show you here this, to my knowledge, best trading approach for the German DAX, which has as input interest rate, seasonality, dollar, and inflation. Yeah, and here you see the DAX, and here you see the result of this trading approach, which is, by the way, a real track record. Yeah, it's from a sir called Gebert. Yeah, he did publish this system since the 90s in a magazine. Now he has also products on it. So this is not just backtesting, and you can see if you have a trading approach here, for instance, inflation, dollar, and rates, whatever yours is, it might be different, just add seasonality additionally. And I don't want to finish this presentation without something to smile. Yeah, these are separation rates. Yeah, and what you can see here is that couples, yeah, these are separation rates from couples, typically or often separate in context of holidays, but for instance also on 1st of April. Yeah, so don't make jokes, bad jokes on April 1st. Yeah, and this is what I wanted to say. Yeah, then here I would like to show you also some examples. Yeah, we can make also some practice now. This is the app which is existing in Bloomberg and Thomson Reuters also for more instruments, and in the internet it's www.appseasonex.com. Yeah, and There you have the popular instruments like Dow Jones or dollar or gold and so on for free. Also a biweekly research report. And for this presentation, we have a special offer because we have more than 20,000 instruments, of course, many stocks under them and many commodities. And with the voucher CMT 50, in small letters, CMT 50, you have a one-time 50% off. Yeah. And here are already questions like coffee. Yeah. Do you have any books? Is one question. To be honest, I have written a lot, and if you go to the website seasonnext.com, there you can also look at all past research reports for free. They're available there. Yeah. So I switched now, if I can manage, to the screen. I hope you can see my screen now.
It's just loading up right now. Okay, there it is.
Okay, and let's go. I show you here the S&P calculated over 69 years, and you can just mark any pattern. Here, for instance, the autumn rally, yeah, and then the statistics appears, yeah. Pattern returns on the bottom, the equity line. On the right side, you have several things like annualized return 23%, winning trades, and so on. Yeah, and just you can here change the period. You can here filter, yeah, for instance, election years, or if you have one year where there was an influence, a very strong movement which was not caused by seasonality, you can remove it. You can make comparison if you want to compare your stock with the S&P, for instance. You can add the current year to see whether the year is somehow the current season is like in the current year. Yeah, and I go back here. Here it recommends you good, strong seasonal patterns. Yeah, for instance, these are very short ones. It's still better. We are still improving this. Yeah, then this is the highest, for instance, in the S&P. Yeah. So this I wanted to show you. Then if you go here, you can, here we have make recommendations like commodities, and here you can enter, for instance, Microsoft. Then it shows you the seasonality of Microsoft. Yeah. And here you have the detrending. Yeah, it just shows you optically that the seasonal movement stronger. Yeah, by putting the end of the chart to the beginning. Yeah. We can also move it, that it does not change this January, that you can mark a pattern more easily. Yeah. Here is, by the way, the strong movement roundabout in Microsoft. Maybe I show you one thing I wanted to show you. This is gold. I go full length. Yeah, good. This is the seasonality of gold. And you see that gold typically starts rising in July until February. Yeah. The reason for this is gold is used a lot in jewelry, like for Christmas there's gold presents, but also in the Indian holiday season, or when the Chinese have their new year. And of course, the manufacturers buy the gold a little bit earlier. And this causes gold to rise in July. Now you know that silver is quite strong correlated with gold, so you would expect that the silver seasonality is also quite correlated. I show you also over the same frequency. This is 51 years. But you see that silver has a very strong seasonality in January, February mainly. And after that, it even drops a little bit. Yeah, and this is because silver is also used in the industry. When the buyers in the industry typically buy in January, February, or also at the end of the year, because then they have their plans done, how much silver they need for the year. So they order all at the same time, and this results in this. Also, the bookkeeping might play a role, because at the turn of the year, the books are open. And I show you also platinum. Yeah, I go also full. And also platinum rises mainly in January, February. Yeah, and then it drops in average. So you can see, despite silver and gold are quite correlated, the seasonality of platinum and silver is more correlated, because there's a good fundamental reason to buy that silver and platinum does rise in January, February, and this causes this difference. So I think I have talked enough for the moment with the presentation and with the showing of the app. SeasonX, www.seasonx.com. Yeah, as I told you, the research report is for free, also the past ones, and also many instruments, the important ones are for free. And for the other users which are more interested in this topic, they can have access to more than 20,000 instruments, and with the voucher CMT in small letters, CMT 50, you get a one-time 50% off. And now if you have more questions, or if you have an instrument which you want to see, I think there was already one, but I forgot which one. Was it coffee? Then you
Hey, Dimitri,
can
it's Shane
type
here.
it.
Yeah, we have a question for coffee and also for Indian markets, if you get a chance to take a look at both.
Okay, this is a seasonal trend of coffee. Yeah, it's a little bit boring. There are more interesting ones, in my opinion. And maybe we have more wishes, or what was the question? Indian market, but I need Nifty is maybe. Here we have the Indian stock market. I think this is Indian stock market. I go to maximum. Yeah, it has a quite interesting seasonal pattern. You see, because it has not the strong summer weakness which other markets have, but it still have a very strong period at the year end. Also in Far East we can see it. Now the British pound, somebody wants against the dollar. Yeah. This is the British pound against the dollar, which has a sideways trend at the beginning of the year, then from March to April, a strong season, and then with high fluctuation, the British pound drops. Yeah. Maybe there are more wishes. The 20-year Treasury bond, I'm not sure whether I can manage with the web app. Let me think, because I need the future most probably, or a bond index, yeah, or the yield, yeah. Let me look what happens when I type bond, yeah, S&P bond index, yeah. Maybe this is, here you can see, here for instance, detrending is of course good, yeah, to show you the seasonal pattern more clear, yeah. And I go to maximum. Yeah, you have in the bond market a weakness starting from end of August until mid of November. Yeah, this is a quite strong pattern. Yeah, and the next wish is the euro. Yeah, I go here to euro, and I go maximum. Yeah, and you have here the strong tendency at the year end and the weakness, which I already mentioned in January. Yeah. TLT, I guess it's a stock, TLT. This is what we mentioned already with the bonds. Thank you for this hint. Some more wishes? Maybe I show you, we have here also cryptocurrencies, for instance, yeah, Bitcoin, yeah, and also the cryptocurrencies have a seasonal pattern, as you can see, a weakness from June to October. And by the way, I did also this intra-week, I didn't show it in the presentation, I think, this intra-week research, because Bitcoins and cryptocurrencies are traded not only from Monday to Friday, but also Saturday and Sundays. And Bitcoin has a strong movement on Monday and Tuesday. And on Friday, Saturday, Sunday, there is very little movement. This was to my surprise. You can read this in my research letter, research report on the website. Maybe one more question or one more instrument. Yeah, I see nothing at the moment, no question. Nobody has a wish for his particular stock.
We've just got one that came in for oil futures and oil as well.
So crude oil, yeah, it's a little bit short. I go to 25 years. It does not change much. That means we have here a weakness from September to December. Yeah, and then we have a bull market from February here to this period, and market also, which is a good period to be long. Here you have the statistics for these particular years. It's quite significant. Yeah, and during this period, we have an annualized return from 80.54%, while during the rest of the year, we have an annualized return, this is here on the right, from minus 7.55. So this is a quite strong seasonal pattern. Yeah. Maybe some more? Copper, many commodities, no stocks. Copper, yeah. So copper has also the tendency, but a little like crude oil, but a little bit earlier to, yeah, let's start here in January until here, 2nd of May. Yeah, but this was caused here with a few very strong years. Yeah, where we also had a bull market in commodities. So this must be analyzed more in detail, whether this is also valid in this period. So I go for shorter period. Yeah. So it was in later period, this period was in later years, in the last 10 years, this period was still okay. Yeah. But we had here the year end a stronger pattern, I would say. Yeah. Still okay, this pattern. Some more question, let me look. Now we have Exxon and Royal Dutch. Exxon, I go for more years, 25 years. Yeah. Exxon has, yeah, how to say, a quite good season here from January to April. Yeah. And a quite bad season, I would say, from here. Yeah. Oh yeah, this is really not good from June to end of August. And then you can already invest again. And then Royal Dutch. Here I have it in, let's take it in, yeah. Let's take it in British pound. Yeah. Royal Dutch typically rises here. This is also 25 years. Here in this period from beginning of March to July. Yeah. And has also here you can see a very strong year-end rally, but a strong drop in January. Yeah. And also a second strong drop in this period. Yeah. Kinross and gold and Barrick. Kinross, it's a gold mine. Here I have it in, let's take it think it's traded in Canada. So yeah, it's quite volatile, yeah, and has no longer strong seasonal period. Let's go with Barrick. This is I take it in a dollar this time. I go longer, 25 years. Yeah, same like with Kinross. It has a strong year-end rally and a few periods, but other which are not too long, which are weak. Yeah, IBM is switched. IBM. So IBM, yeah, it has, how to say, a weakness here in this period, like many stocks, and it fails to deliver a good year-end rally. This is very interesting. Yeah. So there could be more. And yeah, for an investor, the best period most probably is here from January to May, to mid of May. Yep. But also here in recent years, in the last 2 years, also this period was not positive. Some more stock, ENG. Yeah, how do I get it now? Dot, I don't find it at the moment. Epsilon. I take this company, yeah. ENG Group I don't find so quick. So Annaly Capital Management, yeah, which has a strong season from a little bit late November to beginning of May. I move it a little bit and then I can mark it better. Yeah, here from November, now the chart to May. The chart starts now in June, just to inform you. Yeah, this is the best season for this stock. Sorry, it went away. Yeah. Yeah, it's quite interesting this season. One more stock or instrument. Okay. If there's no further wish, we can come to the end maybe.
Yeah, Dimitri, you're welcome to share any other closing thoughts you have, and then we'll go ahead and wrap up.
Okay, I say thank you. I would appreciate if you are interested in seasonality to see you back again on the website seasonx.com. If you have any problems, any questions, please come through and call. We have, as I already mentioned, a voucher CMT in small letter CMT 50 for those who are interested in more than 20,000 instruments and also more features. And we have also some 30 main instruments plus several others like Microsoft and so for free, and the research report for free. So you are welcome. I say thank you to everyone, and it was a pleasure for me to speak in front of CMT audience. Thank you very much.
And on behalf of the CMT Association, I'd just like to extend our sincerest gratitude to you, Dimitri, for today's really outstanding presentation. Dimitri has made an offer for each of you tuning in today that I've put back up on your screen right now. The voucher is CMT50, all lowercase, at www.app.seasonx.com. Again, that is on your screen right now if you want to go ahead and take advantage of that. It is for a limited time only. For those interested, today's presentation has been recorded and it will be made available in our video archives over at cmtassociation.org by the end of the week. If you do have any additional questions that we could not get to today or that you think of while watching the archive, please feel free to email them to me or any member of the CMT Association staff. We will gladly pass them along on your behalf. That will wrap up today's educational webinar series event. for the CMT Association, my name is Shane Skwarek. I thank each of you for spending the hour here with us and hope you enjoy the remainder of your day. So long, everybody.